Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We're getting some details on the investments Japan will be making in the U.S. Today, President Trump announced the first tranche worth $36 billion. Now, this will cover a gas power plant in Ohio, as well as a critical mineral site in Georgia and a liquefied natural gas facility in Texas. This funding is part of the trade agreement between the U.S. and Japan. And as a part of that deal, Japan committed to a total of $550 billion for investments in the states. For a closer look, I'm joined by Bloomberg's Isabel Reynolds. Isabel is our Tokyo bureau chief. Isabel, thank you for being here. Today was interesting. In a post on social media, President Trump said this could not have been done without one very special word, tariffs. Can we agree that tariffs apply the necessary leverage to get Japan to commit to these investment dollars?
It's a little bit difficult to say because we don't know the details yet. We're just waiting actually right now to hear from the government about exactly what is going on, who's investing where, what's happening. One thing we're always wary of with these government announcements is, how much of this is actually new. So we really need to know that before we can sort of definitively say, okay, tariffs really forced Japan with the leverage that forced Japan into doing this.
Do you have a sense of the balance between, let's say, private sector funding versus anything that the government may offer?
Well, what we've heard from the government all along is basically the vast majority of what they'll be offering is basically loan guarantees and things like that. So it won't actually be government money. As far as I know, it's all coming from the private sector. And that is, it's a huge amount of money to come from the private sector. So that's one of the things we'll be chasing today to find out which of the financial institutions in Tokyo are involved in this, how exactly they're going to find this $36 billion, which is it's a small proportion of what Japan has promised, but it's still a very large sum of money.
So this deal was put together prior to Prime Minister Takaichi becoming the first female prime minister in Japan. Is there the expectation that she is going to kind of continue with this agreement, or is there perhaps a small risk that things get modified slightly?
I think Japan is certainly very anxious to make a good impression on Donald Trump. There was a report in the Japanese media a few weeks ago that he was angry that these investment deals hadn't yet come to fruition. So I think the pressure is certainly still on there. And I think this is very important to Donald Trump. He wants to be seen to have brought in this investment into the U.S. So I think it will be difficult for Japan to wriggle out of it.
Do you have a sense of how the public in Japan views this program?
I think Takaichi is seen as basically handling Donald Trump pretty well. What Japanese people tend to be concerned about is the tariffs. And obviously, this deal was intended to protect Japan from the 25% tariffs that could have been imposed if they hadn't done this. So I think largely they're thinking, well, they may not be in favor of doing it, but they may think it's inevitable if they want to get away with doing trade with the U.S.
What is your sense of the relationship between Prime Minister Takaichi and President Trump?
I think in some ways they're on the same wavelength. And certainly on social media, Donald Trump has expressed his sort of praise and compliments for her several times. She's certainly achieved something that no one else has ever done in Japan before in becoming the first female prime minister. She's come from nowhere rather than coming from a political dynasty. So I think he must certainly have a degree of respect for her. What she thinks of him is possibly a little bit less obvious. I mean, she's very good at conveying a sense of friendliness towards him, and I think that's what counts. What she really feels doesn't necessarily matter. So
the U.S. is getting investment dollars from Japan, and at the same time, Japan is getting greater access, perhaps, to American markets. But when I think about what Prime Minister Takaichi is doing in terms of the increase on defense spending, do you think it's likely that the Japanese government will look to the United States for armaments or any type of military hardware to help the Prime Minister reach her goal?
Certainly. I mean, Japan has long been reliant almost entirely on the US. Apart from its own armaments, it's reliant almost entirely on the US for any arms imports. So certainly Japan will be looking to probably buy more. We already had a huge expansion in defense spending in the pipeline when she came to office. She's promised to bring that forward, so she wants to spend it faster. What exactly she's going to spend it on, that's still a little bit unclear. She's giving her first policy speech after her huge election victory. That's coming on Friday, so we may hear some more details there. But one of the problems that's come up over the years is that Japan can buy these things. It pays for this equipment and wants to have it. The US has been very slow at producing it. So a lot of things that they've ordered and paid for maybe haven't arrived yet. I think that's more of the issue that we've been facing recently. So
can we take a step back? Help me understand a little bit about what's going on in Japan right now economically. Are things beginning to turn a corner here? I mean, I know we are dealing with persistently high inflation. There's been some concern over growth, but how are things functioning in the economy?
Yes, well, the inflation issue hasn't gone anywhere. We're still seeing huge price increases, relatively huge by Japanese standards, price increases. That means the standard of living for people whose wages are not going up so fast is definitely not, it's falling. So people are still unhappy. Takeichi has promised to do something about that in the short run in terms of suspending the sales tax on food, so at least people would have the basics at a lower price point. And she's promised to look in the longer term at ways of cutting the amount that people have to spend on social security each month, that's taken out of their salary each month. So she's looking at ways to deal with that, but at this point that hasn't happened yet. She's a very forceful personality, so I imagine the Japanese people kind of trust her to think that she's going to push through with this, but it hasn't happened yet, and so people are still suffering.
So if she has promised an increase in fiscal spending, I'm just wondering about the possibility of a little bit of resentment creeping into the story when you consider the fact that Japan has committed a total of $550 billion for investments in the U.S.
Oh, well, I mean, Japan has a long history of various resentments against the U.S., but ultimately Japan relies on the US for its defense. It has this huge and threatening neighbor, or at least one neighbor, probably two neighbors, that is pretty scared of, and it feels that it needs this ally to help it and secure its territory. So, you know, whatever resentments may build up, I don't think they will ever be enough for Japan to reject the relationship with the U.S.
Prime Minister Takeichi is set to be in Washington to meet with President Trump mid-March. Can we speculate on her agenda?
I think they'll want to sort of make the most of this huge investment. That will be something that they'll both want to sort of underscore. So she'll be hoping, I think, basically to keep Donald Trump on side. That is the one kind of motivating factor behind Japan's relations with the U.S.
Isabel, we'll leave it there. Thank you so much. Bloomberg's Isabel Reynolds. She is our Tokyo Bureau Chief, joining from the Japanese capital here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. There is simply no mistaking the disruptive power of artificial intelligence. Today, Anthropic released a new AI model aimed at using PCs in increasingly complicated ways. Claude Sonnet 4.6 can carry out actions that require multiple steps, such as filling out web forms and then coordinating information across a number of browser tabs. Now, it's clear the equity market remains anxious over the ability of AI to disrupt many businesses. For a closer look, let's bring in Jed Ellerbroek. He is portfolio manager at Argent Capital. Jed is on the line from St. Louis. Thank you for being here. Jed, give me your take on this wave of worry that we have seen related to AI disruption.
Yeah, I think it's both. I do think the market is shooting first and asking questions later. The C.H. Robinson example from last week isn't a special extreme case where like a little penny stock puts out a press release and moves C.H. Robinson stock by 15%. Mm-hmm. But there are software businesses that will be disrupted. Their growth will stop. Their margins will shrink because the AI tools are amazing, and it's going to make that software less valuable for businesses. So I think it's both.
So today we had a number of software companies releasing earnings ahead of schedule just to demonstrate their resilience. Obviously, this wouldn't happen overnight. Is there a timeline in your mind where AI really begins to hit these software companies?
Yeah, that's great. Releasing your results early is great. Showing you had a good quarter, that's great. But that will not satisfy investors' concerns because the concerns lie, like you're implying, a couple of years out. There's nothing these companies can show in their financials this quarter or next quarter that's going to ease people's fears. People fear that a couple years from now, the AI tools are going to keep getting better and better at this incredible rate, and these software companies' growth will stop. Also, the software businesses have traded at exceptionally high valuations for years and years, and so they were especially susceptible to a new technology like this that threatens that kind of competitive advantage, that really long duration that investors believe they would have pricing power. And so valuations have just cascaded down. The other sectors that have been hit by AI fears, some of the brokers, the commercial real estate brokers, insurance brokers, et cetera, those stocks didn't start at such an expensive point as software. And so while they've been hit, they haven't been hit as severely.
I'm wondering, though, whether or not if this AI trade, so to speak, is still durable, that the place to be is on the hardware side, a name like NVIDIA, let's say.
Yeah, obviously, exceptionally strong demands for AI infrastructure right now. NVIDIA and the semiconductors, prime example, but also all the contractors that help build data centers, and on down the line. The Eatons of the world supplying electrical gear that's installed in these data centers. Those stocks are doing really well, but they cannot do well in isolation. The hyperscalers, the cloud computing businesses that are paying for all this, they need to do well too, or else they will not spend $200 billion in 2026 in the case of Amazon, or $190 billion next year in the case of Google. And then on down the line.
To what extent are you skeptical that the hundreds of billions of dollars you just referred to in terms of CapEx will deliver big payoffs anytime soon?
I think that the big tech companies, so Microsoft, Meta, Amazon, Google, the four biggest spenders on new data centers, they are exceptionally smart, exceptionally well informed, very well capitalized, very confident that this AI spending, this data center CapEx, is going to produce good returns for their shareholders. They have very high confidence in that. Otherwise, they wouldn't be spending all of their free cash flow for next year on building new data centers, or in some cases, even more than all of their cash flow. So I think they have an exceptionally high degree of confidence. They are well positioned to know. They have experience in this industry for decades in Amazon's case. So very confident. When I run the math, I put some numbers on paper. I think that they're earning high returns on invested capital as well. And you see it in several kind of metrics on their financial statements. With Meta, you see very high revenue growth, accelerating revenue growth. Google is showing accelerating revenue growth. Also strong margins in the case of Google. Strong margins in the case of Amazon as well. I think you see return on invested capital high there too. AWS's revenue growth is accelerating. But the CapEx exceeds those revenue increases right now. And that's oftentimes the case when you have these really heavy investment periods. I think that's going to be the case for years. But eventually that revenue overtakes the CapEx. And then you kind of have full demonstration of that high ROI on down to the net income line of their income statement. So I think we'll see it, but nobody knows for sure. And there are lots of doubts in the investment community today. Investors just aren't comfortable with Amazon and Google and Meta spending virtually all of their free cash flow next year building new data centers.
So are you bothered at all by the fact that some of these hyperscalers have been going to the corporate bond market to raise funds?
No, that doesn't bother me. They have exceptionally low cost of funds. They're able to borrow very cheaply. Their balance sheets in all those cases have more cash than they do debt. So these are exceptionally well financed businesses. They have very high capacity to borrow, even well beyond what they've just borrowed in the last month or two. So that doesn't bother me at all. I think that's reasonable balance sheet management. I'm comfortable that they're going to get a good return on that investment.
So we talked a moment ago about the extent to which this AI craze, if you can call it that, has been impacting some of the software companies. But I'm wondering about other industries that may not be obvious. And I say that because today we heard from the head of the San Francisco Fed, Mary Daly, and she was saying the Fed must be open to signs that AI will impact other pockets of the American economy. So away from software, You mentioned real estate, I think, as well a moment ago. Give me a sense of the other industries that could face major disruption.
Yeah. Yeah, you say that word disruption, I think, implying kind of like a negative net impact for the shareholders of these public companies. And there are, I think, examples of those. Obviously, software is the primary casualty right now. Um, Call center, customer service focused businesses are going to look very different 5 or 10 years from now. Many of those stocks have performed very poorly over the last couple of years. A couple of them, though, have adapted and are using AI tools to deliver even better services than before and are thriving. So I think there will be winners and losers as you look industry by industry. Finance is another industry that is going to see exceptional change in business processes because of AI. Banks, insurance companies, investment management firms like the one I work for, wealth management firms, there are going to be huge savings in terms of the efficiency of their employees doing the tasks that they complete. And will that be net positive or net negative for their companies? Depends on how their pricing power is impacted from those changes. Law firms around the country, none of them are publicly traded, but all of these kind of like labor-based professions where white collar workers are working on a computer all day, there are going to be huge changes to workflows and how the businesses operate and also their profits.
What about huge changes in terms of employment? I mean, I understand the argument in favor of increased productivity, but I mean, if you're displacing workers, that seems to be a bit of a risk as well.
It is. And I think the data is very inconclusive so far. Over the last 9 months, the amount of job postings for software development people has been rising. All intuition tells you otherwise, would expect otherwise. But no, there's more software development going on today. The cost of that software development, the ease of it has become much greater. And so you have businesses willing to invest in more people to do that. So that's counterintuitive, and I think it's just too soon to say. If you listen to Dario Amodei, for example, the head of Anthropic, he's worried about humongous job loss, but the data hasn't borne that out yet.
What about some of the other industries that are connected to AI? And I'm thinking in particular of energy, given the fact that some of these data centers just require so much power for those servers to kind of function in a way that is basically the way in which these systems are designed, sucking up enormous amounts of electricity. Is that something that you think has been fully recognized by the market? I mean, are there other opportunities here if you're playing the energy space?
Yeah, power prices are rising. Demand is exceeding supply in many parts of the country. And obviously there's great demand for additional data centers to be built all over the country. So yeah, I think that companies that can grow their power generation over the next 5 or 10 years stand to do well, stand to earn good prices for that new power brought to the grid. So a company like NextEra, I think, is a compelling investment today. They're supplying both renewable energy and also gas-fired power to the grid. The unregulated or less regulated independent power producers like Talon and NRG are well positioned too. So yeah, I think that energy generation is more valuable today than it was 5 or 10 years ago, and it's exceptionally important 5 or 10 years down the road. And there are a handful of companies that are going to take advantage of that.
So at the end of the day, Jed, are you still reasonably constructive on the equity market, given everything that we're talking about? I mean, if this major shockwave as it relates to AI is still kind of permeating through the equity space, do you remain constructive?
Yeah. When asked that question over the last year or so, I've said yes. I feel good about the forward outlook for equity markets. And the main reasons for that are there are a lot of things that are contributing to higher stock prices here today. Double-digit corporate earnings growth, tax benefits from Trump's tax bill passed over a year ago. The Fed is reducing interest rates. Unemployment is fairly low. M&A and IPO activity is strong. Interest rates are low. Credit spreads are tight. All that is very constructive. But the market feels a little wobbly right now, doesn't it? There are as many companies seemingly negatively impacted by AI as there are positively impacted. The market investors over the last month have decided that they want to go sell AI stocks and hide out in utilities, in energy companies, in consumer staples that have really modest growth prospects. So that fear in the market makes me think twice before answering your question, and I feel a little bit less confident in a really strong outlook for the stock market today than I did probably 2 or 3 months ago.
All right, we'll leave it there. Jed, thank you so much. Jed Ellerbroek is portfolio manager at Argent Capital Management, joining from St. Louis here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.